So I've been very lucky to literally, I fell into working in venture capital with my first job at Alex Brown. They needed a CFO, a venture fund. All businesses are cyclical, and venture is certainly no exception. It took a long time to repair the damage that was done by the internet bubble because, unfortunately, as is often the case at the peak of a bubble, the late entrants are the largest numbers and they lose all their money. And so, for a long time, I think, it was the winter of venture capital from 2000 to 2010. And I think as a result of that, it was hard for venture funds during that time to raise money. But as was the case before 2000, in the period, I started in 1982, from 82 to 2000. There's been so many great businesses formed that have been backed by venture capital, and there always will be great businesses formed that are backed by venture capital, and there will also be businesses backed by venture capital that will never see the light of day. And so, I think in the internet bubble there were a lot of ideas that were not businesses, and so those things evaporated. We went from venture back in the 80s being a cottage industry with a handful of firms, all of whom knew each other, and some of those firms are still with us today, and many of those firms are not. And then, there's a process of creative destruction where talented people go off and start new firms. And so I think where we are today is, we've had, over the last 5 to 7 years, the emergence of these micro VCs, funds under 100 million, of which we have a database of 600 of them. And then you have, the brand name Series A firms, the Sequoias, the Andreessens, the Accels of the world. And so, and venture capital today is a very global business, and there are great ideas in a myriad of geographies. And I think, if technology will continue to be, and healthcare, because we also invest in healthcare, are two sectors of the U.S. economy that enjoy very strong organic growth, and these are industries that are driven by change. And so I think there will always be great opportunities, and like all investment areas, one has to be careful about where one invests and be thoughtful about it and not be carried away by some of the valuation excesses that we're experiencing today. We're late in the cycle. We've had a 10-year period of enormous amounts of liquidity and very low interest rates, and so we have asset inflation. So, I think there are always risks endemic in any investment asset class, and so we like working with managers that are thoughtful about portfolio construction and how they deploy capital. We invest in the earliest stages of venture capital, so our managers' initial investment in a company will be at the latest of a Series A round. A lot of them are seed investors or pre-seed investors or whatever you want to call it these days. So where you've seen the most amount of valuation acceleration has been in the later rounds where there's been lots of capital coming in. And the reason we don't like to enter at that particular point in time is precisely because we think that is the point of maximum risk, because it's really an arbitrage between where you invest and where you think you're going to exit, largely given these valuations in the public market. And so given that it's late in the cycle and over the next several years, I think most people that I read about think we're going to have some sort of correction. You don't want to be the last one in at a very, very high valuation, but we feel we have price protection by virtue of the fact that our managers invest earlier, and as we discussed earlier, have the opportunity to sell their positions when some of the late entrants come in. So we really do like to see people take advantage of that. So we're not just all trying to exit at the same time at a time when there's no liquidity in the market, because having been in the capital markets for 35 years, I've seen it multiple times. So, and it will happen again for sure. Look, I think every firm is eager to add diversity, broadly defined, to their investment teams. To me, the most important thing is not just adding junior people or adding HR people or finance people. The thing that I'd like to see are general partners with equal carry to their male counterparts. So we're a long way from achieving that. So we'll see what the world looks like. I mean, to me, what I'm excited about is seeing women general partners be, the lead investor on a handful of unicorns that are very visible. So the great thing about investing is that it is a return-driven business, and if you generate great returns, you're going to get that kind of recognition. And so we just need to see more examples of that, and so that we don't talk about it anymore. It shouldn't be part of the conversation. But I spend time at Stanford Business School, and I encourage women to pursue careers in investment management, and I hope that they will recognize that this is a unique opportunity for them at this particular moment in time, because people are aggressively looking to hire, and they should take advantage of that. And so, I think we need to expand the pool, and then, some will be good investors and some won't be good investors. Just because you join a firm doesn't necessarily mean you're going to be a great investor. So it's an apprentice business. It takes a long time to get results in this asset class. It takes 10 years. So you really got to stay in the game.